Watch. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research on a Fed policy mistake, Ryan Pedersen of Flexport on the impacts of Trump's trade policy, and Mark Giannoni of Barclays on why a December rate cut is not guaranteed. We begin this hour with equities near all-time highs following Trump's election win and Chair Powell's latest rate cut. Jim Bianco of Bianco Research saying, "I'm a no-lander." The Bloomberg Surprise Index is at its highest level since February. Now we have fiscal stimulus in the form of tax cuts and deregulation. The Fed is overstimulating and setting up inflation problems in 2025. Cutting rates now, wait for this, cutting rates now might be worse than transitory. Jim joins us now for more. Jim Bianco, that's some punchy stuff right there. Let's build on it. Are you talking rate hikes in 25?
You know, I don't know yet if we're going to need rate hikes. It depends on how many more rate cuts we're going to have. If you look at the market is pricing in about 3 more rate cuts. Well, if we get one in December, because it's got a better than 50% chance, I don't know if everybody's ready for the idea that by the end of the year, this whole rate cutting campaign will be mostly done, if not completely done. If the Fed does want to follow through on the Austin-Goolsbee line, that they have hundreds of basis points to go to get to neutral, then they might overdo it and we'll need rate hikes in 2025.
Jim, considering we're also talking about the potential for a positive growth shock, is that a world in which stocks continue to do well?
Yeah, well, there's only really one thing that's going to stop stocks from going up, and that is the prospects of inflation, overstimulating and creating inflation. Look, if we have no inflation, and if inflation is defeated, as a lot of people say, then why didn't the Fed cut rates to 0 yesterday? What's to stop them from becoming massively stimulative? The idea is that if you are, you create inflation. And the only thing that stops you once you get inflation is the bond market. Yields will go up so much, it will then stop the rally. And so, you know, that's what I think is going to have to be the big fear in 25. Because right now, with all the stimulus we're talking about, both fiscal and monetary stimulus and deregulation, there's nothing to really stop this market unless we get inflation and we get high interest rates.
Jim, yesterday the message from markets seemed to be that just even the prospect of the Federal Reserve not cutting by 25 basis points next month would be enough to tame inflation, sufficient to really ignite that rally in the long end of the yield curve. Do you think that bond markets are getting it wrong?
I don't think they're getting it wrong. I think what it is that we're talking on, election and Fed week. We're talking about a week where the MOVE index, which is like the VIX of the bond market, had a 13-month high at the beginning of the week. We were coming into the week with all of these volatility measures saying that an average day is about a 15 basis point move in the 10-year yield, which is enormous. So we're kind of overreading a lot of the volatility that we've been getting this week with whether or not the trends have been changing. But if you step back and you look at the bigger picture, the uptrend in yields that started with the Fed cut in mid-September, I think is very much intact.
What are you looking for to understand truly the amount of inflation that could be in the system currently, as we heard from Adam Posen, as well as what could really get ignited with the extension of tax cuts and potentially other stimulative measures?
Well, I think, as far as inflation, let's remember what 75% of the average basket is. It's in services. And that's why, I'll come back to Powell's, super core measure of services less housing core less housing services as actually being a fairly good measure, because what it's trying to measure is wage inflation, and it's over 4%. And if we continue to see that kind of measure of wage inflation, I think you're going to start to see inflation move up. Yes, you throw in the potential of tariffs. Tariffs are another form of inflation because they increase import prices. And then you've got the stage set that you could see the inflation rate, which, by the way, seems to have been, I'll use CPI, or core CPI, bottoming around 3% right now. It stopped going down. And then if it does really start doing that and start going up, you could start looking at this idea that we're not in a 2% world, we're in a 3% world, and that should be unacceptable for the Federal Reserve, and they should not be cutting in that type of environment.
Jim, do you think the immediate inflationary impulse will come from tariffs or tax cuts?
Oh, I think it'll probably come from tax cuts, the making permanent the corporate tax rate, and I think it'll also come from some moves on deregulation. Tariffs is a difficult one. I mean, everybody asks me about it, and they're about 50-50. 50% of the people that I talk to about it think tariffs are going to happen, and the other 50% think it's a gambit just to get a deal in place threatening tariffs So whether or not we get them is still an open question. I happen to be more in the gambit side of it, that he's threatening tariffs to get some kind of a deal and that we actually won't see as many.
Do you think the market is over their skis, though, given the fact that we don't know what the margin is going to be in the House of Representatives?
Yeah, it could very well be. I mean, there is an assumption that the stimulus that we're going to get, the fiscal stimulus from the Trump campaign or from the Trump administration, is going to not see many roadblocks. And one big roadblock, especially when it comes to tax policy, could be whether or not we get any kind of a red wave that extends to the House, and extends to the House by more than like one seat, because one seat can always, throw any kind of legislation into order. So maybe it's getting a little over its skis right now, but, it's really hard to argue with the market the way it's been rallying.
Jim, we've been playing a game throughout the week with every cross-asset strategist, which is how high do bond yields have to go before equity investors care? And we've gotten a range of different answers. Some people say 4.5%. Other people say that's a silly question because it really depends on the circumstance that we're looking at. Do you have a sense of what would make this equity market really watch the bond vigilantes much more closely? Do you have a sense of what it would take at a time where it seems like stock traders are unfazed by everything?
Yes, and you're not going to like my answer because it's 425 and we're already above it and we're already at that level. Now, wait a minute, the stock market's at a new all-time high.
Correct.
Again, that comes back to what you're seeing in this market is the emotional reaction of the election and the unleashing of potential fiscal stimulus. So it doesn't matter if bond yields were 525 this week, the stock market was going to go up. But I think once we get past this period, we're going to start to see that these yields right here at this level, and if they continue to move higher, is going to be a headwind for the stock market. Why do I say that? Because go back before Monday. What was the stock market doing in the 3 weeks going into Monday? It was struggling. And why was it struggling? Because yields were above 425. And so I think we're there right now. We're just kind of sidetracked with the euphoria of massive fiscal stimulus coming. And once that wears off, if these yields stay at these levels or go higher, it's going to be problematic.
This is a really interesting point, especially if you look at the areas that have outperformed in the equity markets, which is small caps. And traditionally, small caps are more leveraged to yields that are higher. They tend to do worse. Are you expecting that trade to be a head fake and essentially for the yield space to really reassert itself over smaller, more leveraged companies?
I think over time it will. I think what you're seeing in small caps is that's another way of saying value stocks, because everybody's been running towards value in this last couple of days with the idea that fiscal stimulus just means earnings. It means people are going to show up at your store and buy your products or your services. And that's what's got everybody kind of rushing towards those kind of companies. And so I do think, yes, once we get past this euphoria, it might be somewhat analogous to what we saw in China last month when they started all the fiscal stimulus and their stock market rocketed higher for 2 weeks. And then that was it. And it's really been kind of meandering sideways to maybe slightly lower. So, yeah, we're in the rocketing part for our stock market right now. It might not be done with, but then we'll go into that phase with, OK, we priced it all in. And now we're going to have to sit there and wait to see if any of this stimulus materializes. And then in the meantime, if interest rates are staying at these levels or going higher, it'll start to weigh on it.
Jim, you're one of the best. Always thought-provoking. It's good to hear from you. The super thoughtful Jim Bianco there of Bianco Research. Andrew Honhorn.